Hello everyone, welcome back to my channel. James here. There's this breaking news where our three local banks, DBS, UOB and OCBC, are raising fixed rate home loans to as high as 3.85%. In this video today, we're going to try to dig into the past home loan interest rate history and answer the question on everyone's mind. How much will mortgage rates go up in 2022 just in Singapore itself? But before we begin, I would appreciate if you can help me tap the like button and subscribe to my channel, as I'll be coming out with more of such videos. In return, I will show you a meme I've just created myself. Okay, so without further ado, let's dive in. So let's digest the news a bit. Due to the rising interest rate environment, our three local banks are reviewing their fixed rate packages. In particular, DBS is offering 4 fixed rate packages ranging from 2 to 5 years. All of them are set at 3.5% per annum. This is a very sharp increase from the 1.8% 5-year fixed rate back in 2020. So we are looking at around a 1.7 percentage point increase in just 2 years' time. OCBC announced that it will be also adjusting the 2-year fixed rate package to 3.5%. UOB's rate is slightly higher at 3.75% for a 2-year fixed rate and a 3.85% for a 3-year fixed rate home loan packages. The latest adjustments mean that mortgage rates in Singapore right now are at their highest since the year 2008. Alright, so most mortgage loans are now pegged to SORA since last year's massive shift from the swap offer rate to SORA as announced by MAS. The most important question here is that for many property owners or prospective buyers, how much will interest rates go up in 2022 just in Singapore? In order to answer that question, we need to look at the US federal funds rate, which is directly correlated to the SORA benchmark we use for mortgage loans in Singapore. If we were to look back at the US Fed funds rate historical chart over the past 62 years, we can see how it has gone crazy to 20% in year 1980, effectively killing the housing market back then. The three main reasons that drove the interest rates so high were sky-high inflation brought on by rising oil prices, government overspending, and rising wages, very similar to what we are seeing right now. The US Central Bank has officially increased the benchmark interest rate from near zero in March to as high as 3.25% in September, just a month ago. And what's more shocking is that the Fed isn't done yet. In updated projections, the US Fed signaled plans to lift rates by another 1.25 percentage points before year 2022 is over. This will bring interest rates to another high of around 4.25 to 4.5%. With inflation showing no signs of slowing down yet, we can expect that our Singapore's interest rates will rise in tandem as well. And to answer the question of how much will interest rates go up in Singapore, I'm not sure, but in my opinion, interest rates will break through 4% in the next few months and likely to stay elevated until at least inflation calms down, which means we may be also seeing a recession forming right now. The impact that these new rates will have on your monthly repayments is another big question on everyone's mind. And because finally these fast and furious home loan rates, right, must be pretty scary for property owners. Hence, I've taken the liberty to gauge the impact of these new rates by doing two calculations. Assuming we are buying a $1 million condo or HDB, paying a 20% down payment and taking up a 80% loan for 30 years. The first interest rate is 1.8%, so based on DBS fixed rate in year 2020, and the monthly repayment comes up to around $2,800 per month. The second scenario is based on the second interest rate of 3.5% in October 2022 now, and the monthly repayment actually comes up to around $3,500 per month. So that is a $700 or 25% increase for the home loan package just within a span of 2 short years. And I believe that this is likely not to be the last interest rate increase. It makes sense for property owners to be prudent in this current climate and always to have a rainy day fund. Okay, so before we end off this video, we have talked about all the depressing stuff like high inflation and the potential jump in monthly loan repayments. On the other hand, there's one big winner from all these higher interest rates and loan repayments, and they are obviously the big banks out there. Hence, we're going to do another video, alright, to analyze and compare the banks based on a few financial metrics. If you want to be notified of our next video, do remember to subscribe to our channel and hit the bell icon. And also help to like our videos because it helps in the algorithm. Okay, see you